Hey guys, Tom here from the Investing with Tom YouTube channel. Welcome back to the channel. If you enjoyed today's video, hit like, hit subscribe, and that way you can see future videos as well. So today's video is about Charlie Munger, and if you're not familiar with who Charlie Munger is, if you've been living under a rock in the investment world, Charlie Munger has for a long time, a very long time in fact, been Warren Buffett's right-hand man, and you might recognize him from the Berkshire Hathaway annual meetings if you've ever watched those, as the guy that often just says this.
Charlie? Nothing to add. Okay. Charlie? Nothing to add. Zone 6.
Berkshire shareholders. Charlie? I have nothing to add. Okay.
I cannot talk just as well as you can.
Charlie, you want to elaborate on? No. I was hoping Charlie would have a near-life experience this morning, but...
Now, although Charlie Munger is often a man of few words, when he does speak, it is definitely worth listening, and people flock to Omaha every single year to obviously listen to Warren Buffett, but certainly to listen to Charlie as well. And one of the things I've been doing more recently is trying to finally get around to completing reading Poor Charlie's Almanac, which is the giant book that you always see up here. And throughout that, when Charlie is talking about how he has done so well in investing, there's one or two key points that just keep coming up over and over and over again. So I want to get into that. It's something that is definitely obvious with Charlie Munger's investing strategy if you've ever followed him for an extended period of time. But I want to get into it. It's certainly a useful tip, and it helps us slow down and kind of get away from the everyday ups and downs of the stock market, that is for sure. And it can only help your long-term performance in, of course, the opinion of Charlie. So let's get into it. Here are some top investing tips from Charlie Munger from Poor Charlie's Almanac. So the investment lesson from Charlie Munger essentially is this. It's that firstly, good investment opportunities come along rarely. You shouldn't expect to find them every day or every month or even every year if you're being really strict with where you put your money and only focusing on the few opportunities that are just absolute no-brainers. If you can't explain it to a 5-year-old, if you can't draw on a piece of paper with a crayon to explain your investment thesis, as someone like Peter Lynch might put it, then it's probably too tricky and something you should pass on and keep filtering through ideas. So the first point is that investment ideas are very rare, and it makes a whole lot of sense to concentrate your portfolio on your best ideas. Obviously, we live in a world where mass diversification is the norm, and mutual funds and hedge funds often employ massive numbers of people to try and basically get an opinion on every single stock. If they want some exposure to the healthcare industry, they will hire someone to try and figure out what the best healthcare stock is. And to Charlie Munger, that just doesn't make any sense at all. He thinks you should focus on businesses that you understand, realize that really good ideas don't come along that often at a great price. So when they do, it's worth pouncing on them and forgetting everything else, essentially. And, you've got to keep costs low. So one of the reasons that we know the average hedge fund and the average mutual fund does not outperform the stock market is basically massive amounts of fees. If you are competing against, let's say, an index fund, we have essentially no costs. Everything is just run by a computer, the trades are all run by a computer, versus a firm that has, say, 500 employees and they're all on like 6 figures plus, because that's what tends to happen in the financial industry, then it's no surprise that on average you simply cannot outperform the stock market as a mutual fund or a hedge fund with all those expenses, with all those costs, and in particular the frictional costs of buying and selling quite frequently. And that's the third point of Charlie Munger. When you can find an undervalued business, but it's not that high quality of a business, that's great. And that's the way that Warren Buffett invested for a long time, is he found really, really cheap stocks, but they were tended to be in poorer industries. He would buy them, they would appreciate over a few years back up somewhere in the ballpark of intrinsic value. He would then sell them, and then he would have to go and find something else. And although that works, and it worked really, really well for Warren Buffett in his early days with small amounts of capital, it doesn't scale particularly well to the tens and hundreds of billions that Berkshire Hathaway are now managing. And it also means that there's more steps. So compare that to an investment where you find a higher quality business and you pay up a little bit more for it. But the business is high quality, it's going to grow into the future, all things going well, and it has a really good sustainable competitive advantage, or a moat as Warren and Charlie would call it. So that to Charlie Munger is a much more attractive investment proposition, because although you have to pay a little bit more up front, you don't necessarily have to do anything. You can just sit there for a long period of time and have that single investment compound. And that means you don't have to pay brokerage fees, you don't have to pay taxes because you're basically never selling it. And there's a lot of pros to setting things up with your investment strategy that way. So those are our lessons from Charlie Munger. Focus on your few best ideas, focus on things that you can hold for a long period of time, and do not trade frequently. The fact is, investment ideas come along very rarely, and making a trade, as I'm about to show you in the next part of this video, can detract from your results quite significantly due to some frictional costs. So let's get into that part of the video now. So when I was sitting down and reading this part of Poor Charlie's Almanac, and I say this part, but really the same lesson is scattered right throughout many chapters of this book, I couldn't help but be reminded of an article that I had read, and I've shared a couple of times actually on the channel already, from Fidelity Investments. And Fidelity Investments did a study a few years back on basically looking at which of their clients had the best investment track record. So which of them were making the highest returns after costs, after taxes, all of that kind of stuff. What were the characteristics of these people that were beating the market versus the average investor who was actually significantly behind the market? And what they basically found was that the average investor that Fidelity Investments had was underperforming the stock market. And that was due to a few things that we've really already talked about in the video today, which really are frictional costs. So every time you buy and sell a stock, there's typically brokerage fees that come along with that. And simply human misjudgment and human emotion often gets dragged into investing. So you have people that will get really excited about an investment and about a stock when it's going up, and they'll typically start buying lots of it while it's on the way up. But they won't necessarily sell it when it gets to extreme prices, and they will sell the investments that have been going down a lot. And when you're evaluating things on a fundamental basis, are potentially actually more attractive investments than the things that have just been going up forever and getting to stupid valuations. So that's part of it. So there's the psychology side of it, and then there's simply the fees side of it, and that is really why the average investor is not doing particularly well in the study. And the people that they found did do really well basically fell into one of two categories. So either they forgot they had an account with Fidelity, or they were dead. Just let that sink in for a second. They either completely forgot they had an account and just made no changes to their portfolio over an extended period of time, or they were dead and obviously were not making changes to their portfolio. So having that mindset completely eliminated all of the fees, obviously, because you're not buying and selling and you're not paying taxes and stuff. And it completely eliminated the emotional factor, because you're not buying into this exuberant time where prices keep going up and up and up, and you're not sort of panic selling out of these low prices that just seemingly keep going down. So those are a couple of the things that Fidelity Investments found in their study, and that was just something that kept popping into my head every time I read what Charlie had to say about investments. So this basically came out to two main lessons and two main takeaways for me. The first one is that I really am going to try and continue to have actually Warren Buffett's analogy, which again Charlie brings up in the book, of this punch card, this punch card which has 20 holes in it, and essentially that should represent your entire investment lifetime. So if you only had 20 investments that you could make in your entire life, you would obviously think very carefully about each company that you added to your portfolio before you put them in there. And that's basically the way I try to manage things. I don't necessarily have a hard limit, like after 20 companies, I'm just going to stop investing altogether and leave the portfolio as it is. It's not necessarily like that, but it's a mental framework, I guess, for making sure that you're not actively trading more than you probably should be. And the way I've implemented that in practice is at the start of each year for the last couple of years, I've set the goal of trying to find 1 to 2 really good investments per year. And to most people that look at the stock market, that will seem just obscenely low. But I'm really not ever a net seller of stocks. And I'm continuously putting money, into my investments and into those accounts and accumulating cash and trying to deploy it in an intelligent way. And 1 to 2 investments per year over a lifetime is going to hopefully give me a pretty good track record. So that's what I'm looking to do, is simply find 1 to 2 investment ideas per year. If I find more than that, great. If I find less than that, great. But what it does is it takes the pressure off, and it allows me to look into a lot of companies without necessarily feeling obligated that I have to put money into that investment, just simply because I've spent the time looking into it. And I think that is a trap that a lot of people fall into as well. So that's the first takeaway, the first lesson. The second lesson is that whenever you're going to make an adjustment to your portfolio, so if you've got an existing portfolio of stocks that at some point in the past you obviously thought it was a really good idea to buy these shares, that otherwise they wouldn't be in your portfolio. The study from Fidelity and what we hear from Charlie Munger basically tells us that if you're thinking of making an adjustment to that portfolio, statistically speaking, if you make an adjustment to that portfolio, it's probably a mistake. And that might seem really weird that, every time you make an adjustment to your portfolio, it's a mistake. But I mean, statistically speaking, it is. And Charlie tells us that the key to outperforming the stock market over a long period of time is basically keeping your costs as low as you possibly can, and sticking with high quality businesses that will continue to compound and will continue to have a sustainable competitive advantage. So if you're using that framework, there's very few reasons why you would sell a business. Either the motor's broken, or they're trading at an insane valuation, and you've got an equally attractive business model trading at a much lower valuation, and you simply need cash to put into that. That is really the only situation you should be selling any of these great businesses. So think about it like that. Aim for 1 to 2 stocks a year. That's what I personally try to do. If you want to approach it slightly differently, feel free, but that's the way that kind of works best with my brain, is thinking about it like that. And the way I look at making adjustments to my portfolio is basically saying to myself, Tom, this is probably a mistake what you're about to do. Are you 100% sure that you really want to do this? Are we buying shares in a business well below intrinsic value? I rarely sell, like I say, but if I do sell, do I have extremely good reasons for this or not? Because if you don't, you probably shouldn't be doing it. So that's some lessons from Charlie Munger. I hope you did enjoy the video. If you did, hit like, hit subscribe. I'd love to hear some of your favorite Charlie Munger quotes and lessons that you've picked up from the guy as well in the comments below. So drop them down below. But that's all from me today, and I will see you in the next one. Cheers.